we have severed the link between infection and serious disease and death.
Here we talk about strategy, which means that you need a unanimity. That means also that individual governors have a kind of veto power.
Today, I would like to stabilize our relations, and maybe next step will be to improve Russian-American relations.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 8th of July. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The reflation trade starts to unwind. Treasuries rally, taking yields below 1.3% as Fed minutes show progress towards tapering. The ECB still believes. Bloomberg learns that Europe's central bank has agreed a new inflation goal of 2%, and it will allow an overshoot if necessary. And the former Microsoft chief executive Steve Ballmer becomes number 9 on the list of centibillionaires. Jeff Bezos becomes the wealthiest person in modern history with a $212 billion fortune. So good morning to everyone, especially my floor crew who actually gave me a nice cup of coffee where it says it's coming home on the lid. But let's get straight to the markets. The great reflation trade is buckling around the world. The idea that inflation was returning has hammered bonds, driven stock gauges to repeated records, and also re-energized some of the value stocks. Now it's in rapid retreat. Now driving the drama in the bond market, and it started about 48 hours ago, 10-year Treasury yields sinking below 1.3%, with real rates actually sliding below 1%. Now, even as investors sour on growth and inflation prospects, there are believers in Frankfurt, because Bloomberg has learned that ECB policymakers have agreed to raise their target for price growth to 2% and allow room to overshoot when needed. Now, that marks a significant change from their previous target of below but close to 2%. Let's talk more about the markets with Bloomberg's Eddie van der Walt. Eddie, thank you so much for joining us. There's so much actually going on in terms of treasuries and what exactly is behind that move. It doesn't really make sense. I mean, treasuries, the 10-year under 1.3%. We see growth at 6%. So at what point does it actually stabilize?
Yeah, it's really interesting that just at this point where the ECB is starting to make noises about allowing inflation above its 2% target, suddenly the market is giving up on the reflation trade. And really, I mean, it's significant. The bond market has been leading the charge here with real rates on the 10 years below -1%, and stocks this morning right on the back foot. We're seeing the Stocks Europe 600 down about 1.2% or so, biggest drop in about 2 weeks. So I think this move is starting to get significant. We could just be in for an interesting few weeks in the summer.
Yeah, so what, a lot more volatility or just testing lows?
Yeah, I don't want to get too quick on the volatility idea, because we've been let down by volatility all summer long. But I think particularly if we see oil prices come off as well, which then takes further pressure off the inflationary idea, that could trigger some significant volatility in markets. Yeah, definitely.
Eddie, I know you've been covering oil for us as well also. That was the biggest story of this week, maybe before the Treasury move. I mean, where do we end up actually on oil? And is it something that central banks will look through?
Absolutely. And you know what? Just looking at the central banks, we're seeing this big dichotomy. On the one hand, we're seeing the Fed, who's getting a little bit worried about inflation, right? And the ECB saying, listen, we'll allow inflation to overshoot. And I think, and at the same time, traders are saying, well, what inflation are you talking about, right? We're not seeing this continue. Finally, the traders are saying, listen, this is starting to look like transitory. So it's been a complete change in the market. And at the core of it all is the oil price. Because I think oil is the big dog here that is wagging all of the tails. I think oil is just absolutely, if we can't see some sort of agreement at OPEC, and traders initially thought this spat at OPEC was potentially a positive for that oil price. But I think there's been a reassessment over the last couple of days. Traders are saying, listen, OPEC is a cartel. The job of a cartel is to push prices higher. If a cartel can't agree, then therefore perhaps oil prices are going to come down. And I think that's what we're seeing here. And that could really clip the wings of inflation.
Eddie, very quickly also, when we heard, I mean, not very quickly because we'll spend a good amount of time on it, but when you look at the ECB and, the review and what it means for inflation, I mean, is it just semantics? Because even if they're prepared to let it overshoot, it may be okay in the future, but for now, we're not really seeing real inflation taking hold in Europe.
Yeah, I mean, me and a colleague was, we were joking about this morning. Michael Redo, who's on our Squawk desk, he was saying to me, listen, I'd like by the time I retire to have close to, but just below $1 billion in my retirement account. But it's never going to happen. And it's a little bit like that, right? So they had this target and they're pushing it higher, but they're not getting anywhere near the target. So having an upper limit, it kind of doesn't matter, unless we actually see the market getting convinced that this is going to happen. And at the moment, that's just not the case. And traders aren't convinced.
Thank you so much, our Bloomberg MLive team member, Eddie van der Veld. Now, to talk more about the Fed, inflation, and the ECB, the markets really that have had quite some movement in the last 48 hours. We're joined by James Athey, Investment Director at Aberdeen Standard Investment. James, I can't believe you made it up. Thank you so much for joining us on a day that actually, the day after the UK, not the UK, but England has made it in the final. So good luck also to you on Sunday. Talk to me a little bit about treasuries. I mean, if you look at treasury in the 10-year movement, where does that end up?
Yeah, I think I can probably talk more accurately or in a more informed fashion about the football than I can treasuries at the moment. It's febrile out there, Francine. Obviously, positioning has been heavily skewed. I kind of expected the consensus to get cleaned out in Q1 because I felt there was just an overwhelmingly broad consensus amongst participants about what the future looked like, and there was very little consideration of risks to the outlook. And obviously Q1 was completely the opposite. We just saw this massive acceleration of the reflation trade, and I think that just has led to a situation where there's just far too much positioning in the same direction. And again, the underlying assumptions and outlook that backed up that consensus view, I think, were always overly optimistic and not considering duly the potential risks to that outlook. I don't think there's been a massive change in expectations for the future, but of course, when prices start moving and people start suffering pain, profit and loss pain, then we get these kinds of dynamics.
But James, are you expecting the 10-year to stabilize at 1.23 or something like that? Are we looking actually at technical levels now, if the narrative hasn't changed that much?
Yeah, I think we are. I think we are looking at technical levels. We've gone through a few of them. I think 132, 138 was the sort of bottom of the range. A lot of the technical analysts are now saying that because we've pushed below that, we've closed below that. That's completely invalidated the bear thesis. Actually, technicals are now bullish, but we are approaching the 200-day moving average in the 10-year. It'll be interesting to see how much work we do around there. Again, if that's another technical level that doesn't last long, we could very much see this move accelerate. I think the systematic type flows are always important. CTAs had got very short, had been huge sellers. They've been closing those shorts and flipping long, and that tends to be a powerful flow when that starts happening. So if the 200-day moving average holds, yes, I think we can sort of consolidate and yields will likely pop back up. The other thing which I think concerns me, shall we say, is that throughout this recent period, really, equities have held up very well. Obviously, they're a bit wobbly today, but very much making all-time highs day after day in recent days and weeks. If equities were to suffer from some selling pressures, then really the downward pressure on Treasury yields could certainly build. That's not my base case. I think we will find some stability and yields will probably pop higher, but I think there are definitely risks that could see Treasury yields fall considerably from here.
But James, have you changed at all actually your growth outlook? So because of the variance, which we've known for quite some time, but now it's dominant in the US, has it changed your base case for fundamentals at all?
No, not really. I mean, I would describe this as the market actually coming to us. We had been more sanguine. We have always been in the camp that we're seeing a lot of temporary forces huge and powerful forces, but none of them sustainable over the medium term. We're seeing those forces combine and creating this incredible looking growth and inflation outlook. Underneath it all, we don't think anything has changed in terms of economic structure. We still see there being structural weaknesses globally, low rates of trend growth, if you want to call it that. We're still in a low inflation environment, in our opinion. Once all these forces pass, we'll be roughly back to where we were prior to the pandemic, possibly a little less healthy because so much debt has been added into the system since. So that's always been our view. We thought 2022 growth forecasts were always a bit toppy because the fiscal impulse will be so hugely negative just about everywhere. So no, we're not changing our economic outlook at all. We just think the market is now probably a bit closer to recognising some of the downside risks.
James, what do you make of the ECB review? So we have a Bloomberg scoop, which should be confirmed a little bit later, that actually the ECB is ready to overshoot the 2% target. Does that actually change in what we're dealing with in the nearer term?
No, I very much agree with Eddie that you spoke to previously. It's all very well and good having this symmetry around a target, but if you don't get anywhere near the target, then it's not really making much difference to policy decision making. And I would go further with respect to the ECB. I could bang on for hours about structural issues. There are huge structural issues in the Eurozone. The monetary union is an ill-fitting straitjacket that creates, by definition, divergence rather than convergence, and it creates disinflationary pressures. There's nothing that monetary policy can do about that. And I firmly believe that ECB's aggressive, experimental and hopeful policy decisions taking rates negative, for example, I think they're actually causing more problems than they are solving. So I think they are a further disinflationary force in the region. So if this new framework suggests to the Governing Council that they need to do more of the very same things which have not just not worked but actually taken them further from their target, then I'm even less believing of any notion of 2% inflation persisting in the Eurozone for any period of time. So no, it's a bit of a vanity exercise. I don't see it as being impactful at all.
James, thank you so much. Okay, you have 20 seconds on football. You have 15 seconds. Go. You excited?
It was wonderful, right? I mean, I really thought it was going to be the same that we'd seen all over again, drag onto penalties and then somehow, having missed all those chances, we managed to go out. But I was incredibly proud. I thought the team were absolutely superb. They controlled the game in a way which England teams are not accustomed to doing through history. So very much looking forward to the final, and I definitely think it's coming home.
Yeah, James will also work on charts looking at, I'm sure, productivity and actually the final on Sunday. James Athey there, Investment Director at Aberdeen Standard Investments. Now, coming up, G20 ministers and central bank governors meet in Venice tomorrow. On top of the agenda, global tax. So we'll have more on global tax. And then a little bit later, we'll also be joined by renowned economist and Chatham House chairman, also massive football fan. What a day to speak to Jim O'Neill. We'll talk inflation, emerging markets, and of course, the recovery. If you have any questions for Jim, just write in at IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Hi, Francine. Japanese newspaper Asahi is reporting that spectators will be banned from all Olympic events in the Tokyo area. That's as Japan recommends a new state of emergency to be declared in Tokyo. The economy minister says it will start next week and extend to August 22nd, taking in the entire Olympic period. A 2-week search for survivors of a collapsed apartment building in South Florida has come to an end. The operation has now shifted to a recovery effort after authorities concluded there was no longer any chance of finding life in the rubble. Crews have recovered 54 victims. 86 people are still unaccounted for. A study by staff at the Bank of England has found companies perform better when more women are in senior positions, but that too few are being promoted to the highest ranks. According to the blog post, women in authorised roles at UK banks doubled in the last 2 decades to 20%. However, there is a glass ceiling when it came to more senior positions. The research was based on a novel data set constructed from regulatory information. Haiti's police chief reportedly says 4 suspects tied to the assassination of the country's president have been killed. The Associated Press report also says 2 other suspects were arrested. President Jovenel Moïse was murdered at his private residence. He had governed by decree since January 2020, when parliamentary terms expired without elections being held. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Laura, thank you so much. Now, we'll have plenty more, of course, on the markets. We'll also have plenty more on the European Central Bank. The ECB policymakers said to raise their inflation goal to 2%. We'll hear our interview with the former chief economist Peter Praet and discuss all of that with the Chatham House chairman Jim O'Neill. If you look at European stocks, they're falling. Of course, there is more and more anxiety that the spread of COVID-19 variants will upend some of the growth expectations. Bonds rallying. This is Bloomberg. The reflation trade starts to unwind. Treasuries rally, taking yields below 1.3% as Fed minutes show progress towards tapering. The ECB still believes. Bloomberg learns that Europe's central bank has agreed a new inflation goal of 2%, and it will allow an overshoot if necessary. And former Microsoft chief executive Steve Ballmer becomes #1 on the list of centi-billionaires. Jeff Bezos becomes the wealthiest person in modern history with a $212 billion fortune. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on this Thursday, the 8th of July. Now, Bloomberg has learned that the ECB policymakers have agreed to raise their inflation goal to 2%, also allowing room to overshoot it. Now, the change is part of the biggest strategic overhaul since 2003. It could also give officials the justification for sustaining ultra-loose monetary policy for longer as the economy recovers from the pandemic. Well, we spoke with the central bank's former chief economist, Peter Praet.
It's quite important before the exit from the exceptional pandemic measures, it's the phasing out of these measures. I think it's quite important for the ECB to clarify, the new strategy well before. We have a little bit of time also because of the new variant, which, slowed down the exit from the crisis. But still, it's quite important to conclude. The difficulty of the ECB is that you really need unanimity. It's not like, current monetary policy, where it's sufficient to have a majority to take decisions. Here we talk about strategy, which means that you need a unanimity. That means also that individual governors have a kind of veto power. I cannot imagine a situation, when you conclude the review, and then suddenly one governor will say, well, I broadly disagree, with that fundamental aspect of the strategy. And that takes time. It also means that there will be no mechanistic sort of formula. As we have seen, we have discussed in the United States, for example, it will be more generic and it should be fit to many situations, actually.
The former ECB chief economist's comments come as Fed minutes showed ongoing uncertainty when it comes to the inflation outlook in America. Now, markets, on the other hand, seem to be acting more decisively this morning. U.S. benchmark yields are in a sharp retreat as worries grow over the pace of the recovery and doubts creep in about the longevity of any inflation spike. Well, joining us now to discuss all of this is Jim O'Neill, chairman of Chatham House, a renowned economist, Lord O'Neill, also known for coining the term BRICS. He also worked as chief economist for Goldman Sachs International and as commercial secretary to the UK Treasury under David Cameron. I know you want to talk about football, Jim. We'll save that for last, the best for last. But I need to ask you, first of all, about what's been happening in yields and treasuries, because it's been quite extraordinary. Do you think there's a repricing because of shorts or technical levels, or is it actually a repricing because we worry about the recovery?
I don't know. But it is extremely interesting. It certainly seems to me one of the probable crowded trades in the more levered community of the markets has probably been to short treasuries. And with the move of the Fed, which certainly surprised me a little bit, and crucially, even without focusing on the Delta variant, marginal news that the pace of recovery is at least the pace of recovery is slowing in many parts of the world. And what I suspect might be behind it is now 2 consecutive months of evidence of a possible significant slowing in China, I'm guessing it's kind of wrapped into all those things together. But I think, as with many other things the past 18 months, it's probably a little bit early to jump to too many conclusions, but it is definitely the most interesting thing going on in markets, and that's even without the spread of this so-called Delta variant, which at least in the UK appears to be spreading dramatically. Virtually every other instance I chat to somebody about some part of normal life, and there's disruption going on all over the place because of the people getting infected. Anecdotally, it seems to be bigger than any of the other strains we've had in the past 18 months, and yet, of course, the government has announced it's going ahead with its opening up.
So how does this end up? I mean, again, given what you've just explained, if there's some kind of Delta variant that is even worse, does it really mean that we'll have to reprice most markets? Or is it toppy at the moment because of fundamentals, or is it just the market working through things?
I mean, I think the reason why I say that at the end, and I hope for everybody's state of mind and everything, and health and welfare, what I'm about to say is wrong, but if it turns out to be that this Delta spread is just so powerful, and that either the vaccines aren't able to cut the spread to so many people who are yet to be double jabbed, then it is going to have a negative impact on people's behavior. Ironically, irrelevant of what governments decide. So if you take, for example, the hospitality industry, which here in the UK, and I'm guessing probably in most places, is amongst the most severely affected. Even ironically, as the formal rules are to allow life being back to normal, I know of just in my own circle of a number of hospitality places now being closed because of a lot of young people being infected by Delta. And so if that carries on and accelerates, then that's going to in itself harm the economy. And doesn't take a big stretch of imagination to see the same happening in other parts of the world.
Jim, harm the economy in a meaningful way? I mean, when we started lockdown, right, just a little over a year ago, this was the biggest concern, is that people started, stopped spending, that people were too afraid to even go out. And actually, the last 14 months was a bit different. So unless there's maybe a new variant, how much of an impact could it have on forecasts?
As you know, Fran, and all your viewers and readers live and breathe, in the world of financial markets, it's the marginal information that matters, and what's been really happening the past year. And I've been, even though I'm not an active participant, I'm sufficiently got it in my veins, and I'm involved in all of this. More and more people have got more and more optimistic about the recovery as time's gone on, and I've believed it myself, and one of the earliest, and I've believed it more and more and more. And so the dilemma, and the markets have priced it. That's partly why bond markets weakened so much late last year, and why we've seen this ongoing remarkable strength of equities. But if it now is the case that the marginal rate of recovery is going to be weaker than what everybody's forecasting, the markets are going to adjust, and it might well be that's exactly what's already happened in the past week. The speed in which modern financial markets adjust to the marginal new set of information is as powerful as ever, if not even more so. And it might well be that that's what's going on. What is also interesting is, despite the endless chatter about inflation, the really credible measures of inflation expectations, and I think I said to you last time I was on, I watch it and have done for decades closely, the University of Michigan 5-year survey. It's not picked up. In fact, in the last report, it came back down again for the second consecutive month below 3%. So, it might well be that the markets have priced all the fears of rising inflation, and we're now starting to see some signs of the price increases easing, which means that actually there isn't any real evidence of underlying inflation, at least yet.
Jim, what do you make of the strategic review, by the ECB? We could see a change in the inflation target marginally, but actually because inflation we're nowhere near 2%, does it really make a difference to the markets?
Well, I think structurally and strategically, it's a huge thing. To be honest, I hadn't really appreciated this had happened. Too focused on sport and football, but it's a huge thing given the background environment and of course the historic role that the German Bundesbank has played as a sort of role model. It's something that I personally, on an intellectual basis, hugely welcome. The ECB has had a ridiculously rigid approach, so I think it sounds like a very sensible thing to do. And of course, if it would have been announced a month ago, in the mood the markets were then, it would have freaked out the bond market and probably contributed to a rise in gold and Bitcoin. But as you say, actually, in this current circumstances, the question is, well, does it really matter in the short term? And it probably doesn't. But I think over the medium to long term, yes, it's really important. And I think, at the margin, for some of the so-called Club Med countries that have had their nominal GDP growth constrained by very rigid fiscal and monetary policy frameworks for 20 years, this, in my view, is really welcome news, particularly for your home country, Italy. I think it's really good news if this is a serious shift, and it sounds like it is.
It is. I know you also want to talk about football. Oh my gosh, England, Italy, but we'll save that. Jim O'Neill, Chatham House.
It's not Manchester United.
No, I know it's not, but I'll still ask you about it and whether we can see actually UK economic bounce. Jim O'Neill will be back in a couple of minutes. Coming up, the Chinese economy's Great Wall. We'll also ask Jim O'Neill the role of China in the global economy and the outlook for emerging markets. This is Bloomberg.
Next year, we will continue still have the stronger recovery momentum that will continue. So with that, I think we are still very optimistic for next year.
What we are doing now is monitoring that process day per day. And we will respond the moment in which we see that we have not the inflation properly anchored.
Right now, sentiment, I think, is very positive in the market. Everybody's watching out for the rate of vaccination. We're hoping it accelerates further, and that should bring more confidence to the market.
Well, some of our big name guests on the prospects for emerging market recovery. Still with us is Jim O'Neill from Chatham House. Jim, we talked a little bit briefly about China. I mean, China at the moment seems a little bit of a dichotomy when you look at, maybe some of the defaults that we could see, some of the policy, and certainly the crackdown on technology. Is China a good player for the world, or actually is it something that we need to watch out?
Well, it's certainly up there in terms of importance. As you know, I've believed best part of 20 years now since the whole BRIC thing. In terms of marginal change, China's the single most important place for world GDP and most sectors that anything to do with it. And what actually, as I touched on before the break, is interesting, in addition to the issues you've raised, the big surprise of late spring, early summer is that the Chinese economy appears to be slowing. And that's not what was really expected. And some of the indicators suggest a significant slowing. So it's a particularly complicated twist for Chinese policymakers, where they've got all these issues where they seemingly are trying to be really tough on some of their own top tech players, as well as the ongoing battles they've got with the US and other parts of the West. So this is another delicate moment for China. as I touched on earlier, I find myself wondering, because of the importance I attach to China, whether indirectly maybe it's that which is starting to also contribute to the move in bond markets the past week or so.
Yeah, and I guess we've seen, I mean, yesterday there was a surprise move, Jim, by the PBOC that, they suddenly said that actually the economy needed more support. So the baseline, and it could be, as you say, something that's being played out in the markets. But overall, do you have the confidence that policymakers will calibrate it so that China, will be steady?
Well, I actually wrote something about all of this via Project Syndicate last week. Generally speaking, the past 30 years, in fact, if not always, not generally speaking, when the Chinese have got a significant problem to face at the moment, it's quite remarkable how successful they have always been at dealing with it. And it is really interesting that they've shifted so quickly to suggesting that they're going to move to ease monetary policy. There's talk about reserve requirement moves around already, of course. And that's a big change already, and it's certainly what would be needed, because if you look at the speed of the move of the RMB earlier this year, and the outlier of Chinese bond yields, and the fact the economy is slowing, and now a number of weeks of weakness of the Chinese stock market, it looks to me they probably need to certainly get out of their heads the idea of being tough, because otherwise they're going to undershoot growth. And given that they've got, and the thing that makes me a little bit more concerned about their ability to manage it than in the past is, of course, there's now more and more signs that their demographics are turning against them. And so they really do need more productivity improvement to reach their own, albeit more modest, growth targets. So it feels to me that this is going to be a trickier moment about the Chinese economy and its interplay with the rest of the world than I see most people even focusing on. And that might be what is contributing to some of the behavior in markets, I suspect.
Jim, now you may have heard, I don't know if anyone's heard, but there was a football match last night. The results are dominating the papers this morning in the UK. Take a look at today's front pages. England beat Denmark 2-1 after extra time, with the winning goal scored by Harry Kane after his penalty was saved by Kasper Schmeichel. It sets up their first final in a knockout tournament since 1966. They'll be facing Italy in the final, in case anyone didn't know. Jim, first of all, does this make up for the disappointment of 1990 and 1996?
I mean, it's remarkable. I was a very young boy in 66, but I remember watching it on TV in our family living room, and it was I vaguely remember the sort of sense of mood and excitement around that followed, and for our country, with a history of the importance of football and its still ongoing importance as easily the most or the biggest participation sport in the country, it's a huge thing. And so between now and Sunday, the country's going to be completely nuts. And of course, if for some reason we beat Italy, that'll carry on into next week. A lot of people like to talk about how that sowed the seeds for a big boom in the economy, but as a lot of others also focus on, well, not necessarily. If you really look back at the evidence, within a year of winning the World Cup, the UK was going to the IMF with a begging bowl related to what was an enforced devaluation of the pound. So, we have to be a little bit careful to not get overly carried away on things like that, in my opinion. Looks to me,
I mean, you're absolutely right.
Notwithstanding everything I just said the past 50... Sorry, go on.
No, go ahead.
Go ahead.
No, I was going to ask
notwithstanding everything I said the previous 15 minutes, the mood about the UK economy amongst the sell side, and again, I've been guilty from my angle, thinking we're going to have a huge recovery. It's not impossible that might be peaking out at the same time as this. So perhaps it gives an additional boost to consumer confidence, that's for sure.
We heard from Gary Neville last night saying Gareth Southgate is a true leader, one of those that we've lacked for years. Do you agree?
Yeah, it's fantastic to see the way he presides all of this, and for him to come and face the media within literally minutes of such an emotional experience and have the charm and grace and courtesy is something which is also quite atypical of past England football managers, and certainly, as Gary points out, not exactly what we've become accustomed to with other important figures in the country in recent years. So it is fantastic, and it also is the case that, as demonstrated with one of the players last night, he's pretty ruthless when it comes to making really important decisions during the game. And it's it's brilliant to see, and maybe he should set up some kind of school for leadership so he can advise some of my pals in Whitehall and maybe me and a few others about how to do it properly.
Brilliant. Jim, thank you so much. Jim O'Neill there, Chatham House chair. Good luck. Maybe we'll catch up next week as well after the final, Italy versus England. Now, coming up, the World Health Organization.
Will you still speak to me, Fran, if we beat you?
I mean, I'm sure. I know I'll get a lot of banter. Let's say I won't be able to forget for at least a decade that England beat Italy if you win on Sunday. Jim, thank you so much. Have a great day. And, of course, enjoy the final. Now, let's go back to COVID. The World Health Organization urges caution on reopenings. Most regions grappling with a sharp rise in cases. This as the global death toll tops 4 million. We'll have the latest next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the World Health Organization is urging caution over reopenings as regions across the globe have seen increasing COVID-19 infections over the past week. The UN Health Agency says more than 24 countries have reported epidemic curves that are almost vertical spikes. The death toll globally has now surpassed 4 million. Now, concerns about the impact on global growth are weighing in on stock markets this morning. Now, there's quite a lot going on. It was an interesting conversation we also had with Jim O'Neill, pointing to the fact that we heard from PBOC yesterday that they need to give a little bit more support for the Chinese economy. That could also be filtering through some of the markets. European stocks falling. There is more anxiety that the spread of COVID-19 variants will upend some of the growth expectations. You can see bonds are actually rallying. The dollar and yen firming on haven demands. Oil, this is the other big one that we've been talking about all week. Oil declining as investors are awaiting further signals from OPEC Plus on production plans after a breakdown in talks this week. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Danny Berger with me here in London. And this is Bloomberg.
I think it's fair to say that, at least in the US, we probably have hit peak recovery. You're less likely to get these kind of upside surprises.
Yes, we have seen peak growth acceleration in the US, but that baton of growth acceleration is getting shifted from the US to Europe, to Japan.
What we know about the stock market over a long period of time is that if you have confidence in the economic outlook, equities are usually the best place to be.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, July the 8th. Our top stories today. The ECB policy makeover, it's making a significant change to its old strategy on inflation. Talking taper, the Fed's not ready with a timescale to scale back asset purchases, but officials do want to nail down a plan. And no fans in the stands while surging virus infections have Japan moving closer to a no spectator Olympics. Well, good morning, everyone. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off today. Matt, quite a lot going on in the markets. We're not talking about football yet. Quite a lot going on in the markets because of the repricing on treasuries. And you spoke to Jim O'Neill, who was saying, look, it's not only about Fed tapering. It's really also what's happening with China and concerns about growth there.
Yeah, and you can see a lot of what we see driving the markets is originating out of Asia, not just in terms of economic growth, but also regulatory crackdowns, etc. Here you can see the map. It's mostly red, and the big faller really was the Hang Seng index in Hong Kong, getting hit hard again today by the big tech stocks that investors worry about most when it comes to increased regulation. You can see that Tencent and Alibaba, or you will see briefly, that Tencent and Alibaba are two of the biggest losers on the Hang Seng. It's getting to the point where I remember their numerical tickers, and they're not easy normally. I guess these are pretty easy, 700 and 99.88. But down 3-4% here. I also thought it was interesting to see the yen. The move today is not huge. The dollar can now only buy 109.90, but we were just above 111. So it looks like investors are starting to get worried, and maybe that's why, as you said, as Jim O'Neill said, they're buying treasuries even as the Fed turns hawkish. They're buying the yen against the dollar. Maybe we'll see more of a search for safety throughout the session in the U.S. this morning. Danny, what are you seeing across Europe?
I mean, it really is the entirety of the bond market that's being bought up here, Matt. Not just in Europe, but the Chinese 10-year yield falling below 3%, seeing a significant drop, its lowest since August, and that negative risk aversion really feeding through to the European session. I mean, you are hard-pressed to find any green over here. The breath is really bad in Europe. For every one stock gaining so far today in the stock 600, there are 10 falling. And you want to get signals that China is having an impact here. You look at things like the Kakaroan underperforming, down more than 1.7%. A lot of those luxury goods companies getting hit hard because if China growth isn't coming through, that's going to be a big part of their revenue stream that's taken away. So those negative growth concerns throughout the market. As I say, bond buying going in. Your German 10-year bond yields lower by almost 4 basis points. We have almost 1 basis point on the Italian 10-year yield, even though this spread usually widens out pretty significantly. Again, it is an ugly day in Europe, despite the fact that we have an ECB that says they're going to target 2% and allow for an overshoot. Sebastian Gailey over at Nordea says all of that is being overshadowed this morning because of the deep risk aversion. If you want to find something that's in the green, perhaps you have to look for football-related things. Deliveroo, one of the best performing stocks today. Apparently, not just are they only upgrading their forecast, but Joe Easton on our stocks team saying that delivery stocks are doing very well during the Euros because people aren't going out as much and ordering in. So at least that's one bright spot in the market at the moment. Let me show you your U.S. board because, again, it is really, really deep risk aversion. You have a U.S. 10-year yield below 1.27. You have a 30-year yield below 1.9 at 188.26. S&P futures looking pretty negative, down almost 1%. But again, if you want to see why growth concerns are really driving this or have evidence for that, look at what small caps are doing today. Small caps down almost 1.5% in the pre-market session. I mean, this is a market that's concerned about growth, Francine. Regardless of what the FOMC minute said yesterday, it is a very different tone, a really negative tone, the likes of which we haven't seen in quite a while.
Yeah, it's, I mean, a really, really massive move that we've been following very closely. Danny, thank you so much. Danny, I thought we said we wouldn't talk about football before 5:30 a.m. New York time.
I broke the rules.
I know. Hold it together for another 20 minutes.
All right.
Danny Berge, that's with some of the main movers today. Now, this is what else we're watching today. First of all, we'll get U.S. initial jobless claims, 8:30 a.m. New York time. Then the EIA crude oil inventory report follows at 11 a.m. It's all about the ECB as well. They'll publish the results of their strategic review at 7 a.m. I know there was a nice Bloomberg scoop on exactly what they'll be targeting, and then the president, Christine Lagarde, holds a press conference about 90 minutes later. So let's get more on this with Alexander Weber. He's a Bloomberg European economy reporter in Frankfurt. Alex, thank you so much for joining us. The focus, of course, is on the inflation targeting, which gives it a little bit more room. What does it mean exactly having it at, near or above 2%?
Hi, so the previous goal of below but close to 2% was seen as too vague, and also it's been blamed for helping keep inflation too low in the past. So there's always been, as soon as inflation picked up, there was the expectation that the ECB was going to tighten very quickly. With a more clear focus on 2%, it could theoretically lift inflation expectations and help the ECB achieve its inflation target of 2%. And we're going to be looking for the details on how much overshoot it will allow.
How helpful is this? I mean, they can't even hit 2%. They can't get close to, but slightly less than 2% on the core anyway. What's the point of raising the target if you can't meet the target you've already set for yourself?
Well, it's more about forward-looking, and it's also going to be about the implementation of this new goal. So we have this new goal, but it remains to be seen what it means in actual monetary policy. And there's of course scope for disagreement, but this new target could be an excuse, for example, to let emergency stimulus run a bit longer, or have a more accommodative policy in place for longer, and that could help lift inflation and anchor it also more in the medium term, as opposed to choking it off quickly once it starts rising.
Thank you so much. Bloomberg's Alexander Weber, there, a reporter in Frankfurt. Now, let's also turn to Japan, which may be moving closer to a no-spectator Olympics. The government has just announced that Tokyo will be in a coronavirus state of emergency for the entire period of the Summer Games. Now, for more, we're joined by Bloomberg's Deputy Bureau Chief in Tokyo, Sophie Jackman. So, Sophie, what exactly, how much of a setback is this if they're not going to have spectators?
So this state of emergency will run through the entirety of the Games, and it's not a European-style hard lockdown, not a huge surprise either, with virus cases increasing in the capital, and it's definitely well within the realms of Plan B for the organisers. It shouldn't change the experience that the athletes and other participants have, but the state of emergency is designed to keep the general public from going out and about and increasing that infection risk. And so the last tool that the Olympic organisers have in their toolbox is to keep spectators out of the events entirely. They were looking at limited numbers of spectators allowed in. So not a massive surprise. The Olympics certainly not going to be cancelled, we don't think. We've got less than 2 weeks to go, so they're full steam ahead, except on that spectators front.
Right, hopefully for the athletes, they still get to do something for the record books. What was behind the decision by the Japanese government to go full emergency?
Well, we do have those rising cases here in Tokyo, the Delta variant being particularly prevalent here in Japan in recent days, and also signs that the hospital system is coming under pressure here in Tokyo. Those are the metrics that the expert panel used to advise the government earlier today to make that decision. And we should note this government needs to be really sensitive to public opinion on the Olympics and the virus and how they manage those two things. There's a general election coming up just a couple of months after the Olympics are over, so the government really cannot afford to mess this up, and that'll be behind that decision as well.
Sophie, thank you so much. Sophie Jackman there in Tokyo. Now let's get a look on some of the stocks on the move pre-market. And I do have a lot of more macro type moves for us just because that really is dominating what the markets are doing. Again, this risk aversion really present through the market. So this is a VIX ETF. The idea here is it's going to buy or at least give you exposure to the front end of the curve, and then it's going to multiply that by 1.5%. So it's no surprise that this is outperforming an ETF land pre-market, up more than 10%. We are seeing a VIX that's edging ever so closer to 20% as those fears ripple throughout the market. But I should say the VIX curve is really, really steep at the moment. So people are pricing out on further away concern about volatility in the market. And look, you're not even going to get that much upside this morning from Apple. Let me show you what that's doing pre-market, because yesterday it hit its first record since January, but it's down 1.7%. Again, people aren't even fleeing to safety in the large cap tech. Bad news for Apple, again, which just was able to hit another record. Now, one of the other assets that's underperforming today is everything in crypto land, be it Bitcoin, be it Ethereum. You have the PBOC saying, look, we are concerned about financial instability due to cryptocurrencies. That's seeming to weigh heavy on them today. So of course, if cryptocurrency is doing poorly, you have all of these stocks that follow suit. One of them is Marathon Digital, down more than 6%. Francine, I know a lot of Bitcoin enthusiasts are going to be disappointed that, again, when we're having this risk-off day, you can't get any diversity, you can't get any safety from a cryptocurrency asset.
Yeah, I know, one of the biggest stories. And we also have a wonderful, actually, big take on Bloomberg. So I urge everyone to go and read it.
Wait,
on
no hip-hop?
cryptocurrencies.
No
You can
hip-hop
find that.
stocks?
No hip hop.
Not today.
No hip hop. It is up a lot today, though. I will say, again, it is up a lot, and I still don't understand it, so I'm not touching it.
Well, yesterday it was up a lot.
They were up
and
late.
then it dropped a lot, right?
Yeah,
Yesterday
for
it
those
was
who
up
don't know, this is
17% when we were
CPOP,
on air,
the
and then it
stock.
fell 20%. Yeah.
It is
Okay,
so
CPOP.
volatile. It's very confusing.
Yeah, it's tracking Bitcoin. Coming up next, Andrew Sheets, Morgan Stanley Chief Cross-Asset Strategist. We'll maybe talk to him about hip-hop. Maybe we'll talk about cryptocurrency. And then later on, we talk ECB, the minutes, and we talk the strategic review with Ralf Preusser. He's Bank of America Global Head of Rates Research. I know he'll have a thing or two to say about Treasury yields as well. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Francine Lacqua and Danny Berger, both in London. Kailey Leinz, normally in New York, is off this week. Now, we have a lot of really interesting moves in rates to look at. And as Danny and Francine and Jim O'Neill have pointed out, there are big moves in China, but also across Europe and still in the U.S. as well. We're looking at 126, I think, right now on the 10-year. Danny put together a pretty awesome chart this morning showing the 10-year yield down for 7 days. If it closes down today, 8 days in a row, that'll be the longest streak since 2019. I love this chart just because there's so much red here at the end and there's no green patches. It looks like somebody, took their wheatgrass clippers and just cut it off. I'll tell our listeners on radio, and welcome you as well on London DAB Digital, as I do every morning, that the point is we're seeing continued buying in treasuries. It looks like investors are searching for safety here. And why? If U.S. growth is so strong and the Fed is turning hawkish and we're even starting to talk tapering. Joining us to help answer that question is Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley. And Andrew, today it looks even more concerning because it's not just in the U.S. Everywhere, it looks like investors are running for cover. Why?
Yeah, good morning. It's nice to be with you. So look, I think you look at a lot of market metrics and we're going through a bit of a growth scare. I think that's helps explain the move we're seeing in yields, both in break evens and in real interest rates. You see it in stock market leadership with some of the more cyclical assets markets underperforming, some of the higher quality markets outperforming. So, I think it's a mix of markets being a little bit worried about growth. I think you're into a seasonally kind of more uncertain time for markets, also seasonally a time that's better for bond markets. And, we clearly have some unanswered questions around the Delta variant. And while, our analysts think that the vaccines will prove highly effective against Delta, we're in a period where cases are likely to keep rising in key areas where there's a lot of uncertainty. And so I think that's also weighing on sentiment.
But Andrew, what exactly is the question there? So I don't know whether, markets are concerned about what's happening in China, which is a very clear, surprise shift by PBOC yesterday saying that the economy needs some additional bank support because it's difficult to get out of COVID-19. So the exit route is a little bit more murky. Is that what they're looking at and trying to price in?
Yeah, thanks, Francine. So, yeah, I think China is central to all of this. I think we have seen recently some weakness in the data. I think also China has had recent lockdowns directly related to COVID-19 that's caused a hiccup in those growth numbers. You've seen some weakness in metals prices, which while we think were also related to those prices simply being above what fundamentals could justify, kind of reinforces a growth narrative. And then you've seen some other regulatory pressures on that market. So look, China's very central to any global recovery story. It's probably interesting that, over the course of this year, as a market, we've probably spent less time talking about China. We spent obviously a lot more time talking about the Fed and Europe and other markets. But I think that that's contributing to this narrative that there could be some growth uncertainty. And I think kind of for better or worse, we might not get clarity around that growth picture until later in the summer, September, that we're into a period where some of the data may be a little bit mixed until we see more clarity a little bit later on in the year.
So if that's prompting growth scares that's rippling throughout the rest of global markets, does that mean we've seen the cycle high in the 10-year yield?
Thanks, Danny. I don't think we have seen the cycle high in the 10-year yield. I think it will ultimately continue to move higher. We still at Morgan Stanley forecast that the 10-year yield will hit 1.8% by the end of this year. So I think there is still room for it to move higher. It's simply that I think the catalysts for that are better or worse, kind of later in the year. I think that's when the labor market data could finally look a lot cleaner. You have school back in session in the U.S. in September. Summer's over. Some of the debate around the unemployment assistance, extra unemployment assistance, should be resolved by then. The Fed, we think, will start talking about tapering in September. So we think there are some catalysts there, and I think confirmation that this is just a pause in the growth data, a pause in the China growth data, not something more serious. I think all of that will come through. It's just going to take a little bit longer to come through. And so we don't think we've seen the cycle highs in the 10-year. We think that ultimately, there is more room to go in this cycle, but the catalysts for that, unfortunately or fortunately, don't lay for another month or so.
But Andrew, where does the 10-year yield actually find a floor? Is it right now moving on technical?
Yeah. So look, I think we are moving on some technical factors. I think the market's focus on it, maybe tells us something about where positioning is, that investors were not expecting yields to fall, which is, why I think this move has been so surprising. We were not expecting yields to fall in the way that they have. Now we are now through a minus 100 basis points in real yields. That seems quite low. So it's hard to pinpoint specific factors here, but I do think that I think we've seen the bulk of this rally. I think markets also may settle down for a bit of a choppy, more sideways move over the summer as you have these competing forces of summer seasonality is good for bonds. The carry is still positive for bonds. You still have COVID uncertainty over the next couple of months, but in September that potentially these catalysts that could take yields higher are coming.
Andrew, thanks so much. Andrew Sheets there, Chief Cross-Asset Strategist at Morgan Stanley. Now, a little bit later on Bloomberg Surveillance, an exclusive conversation with the U.S. Secretary of Transportation. He's Pete Buttigieg. That's at 8 a.m. in New York, 1 p.m. in London. But coming up, much more market talk, yields moving. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off today. Now let's get straight to the Bloomberg First Word News. And in Haiti, police reportedly have shot and killed 4 suspects in the assassination of President Jovenel Moise. Well, according to the Associated Press, 2 others were arrested. 3 police officers who were being held hostage were freed. Still no word on who the assassins were. The global death toll from the coronavirus has now reached 4 million. A growing disparity in vaccine access has left poorer nations exposed to outbreaks of more infectious strains. India accounted for 26% of the increase, from 3 million to 4 million deaths. And in football, England will play in a title match for the first time in 55 years, while Harry Kane converted the rebound after his initial penalty was stopped in extra time to give England a 2-1 win over Denmark in the European Championship semi-finals at London's Wembley Stadium. Well, the English return to Wembley Sunday to play Italy for the championship. There you go. Now we can talk a little bit about football. I'm torn. Both great. This is probably the final that UEFA wanted, just because it's so emotional and you have 2 great teams.
Yeah, I'm excited to watch the final. I'm flying back to New York on Saturday and hopefully going to watch the final with Pharaoh. I will root for England. He will root for Italy. But, last night kind of confirmed my concerns that soccer is really boring. Aside from the horrible call for the penalty, it's not exciting to watch Danish players be so tired and English players not really score.
Yeah. Well, what's not boring, Matt, is actually the markets. The markets are definitely on the... I actually did not think the match was boring, but never mind. The markets are on the move. We look at treasuries. We look at, as Danny was saying, a lot of futures taking a leg lower in the U.S. as well. Coming up, we'll talk markets with Ralf Preusser, Bank of America Global Head of Rates Research. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off today. Now, we're definitely, Matt, seeing the markets move. Now, we were watching what was happening to the yield yesterday. A lot of, I think, short selling out there. There was also a lot of concern about technical levels. I have to say today, it's also the narrative of what's going on in China. And maybe there's a little bit of anxiousness about what we're seeing in China, the fact that exiting COVID-19 may not be as simple as we thought.
Yep. Well, if you were selling rates short yesterday, I guess the cover today is why we're down at 126. I have heard people say, you know, this looks very squeezy, but yeah. It's a big move down in treasuries, and you see it, as Danny pointed out earlier, rippling across the market. You spoke with Jim O'Neill an hour ago. He said the Chinese concerns are maybe part of the basis for this, and we see a drop below 3% there. We see a total sell-off in rates here in Europe. Bunds are now yielding negative 33 basis points.
Right.
And you see a sell-off in risk assets. So, yeah, it makes sense.
Yeah, and Danny, you pointed out that also it's, you know, the E-mini Russell that was maybe selling off more than others.
Yeah, exactly. Because the question, as we're in the middle of a sell-off and really everything is red at this moment, if you see more intense selling in more cyclical parts of the market, that's when you get these concerns of what's driving this. Is it growth concerns? And I mean, this is a market that, at least for the moment, is screaming out, yes, Russell 2000 futures dropping more than 1.3%. But if you want to look for safety anywhere in the stock market, you're not going to find it. Look, we have had previous days where you have growth concerns. You have this really clear shift into growthy names away from value, but you're not even really getting that today because look at NASDAQ futures, down 1.1%. Dow futures, which I don't have on the board, but those are down about 1.2%. And that's similar to Europe. Again, these are more value names that are getting hit harder. So again, it does appear that the market right now is pricing in a way that you would if you think growth is going to be slower from here on out. And we talked about China concerns, that really setting the tone. One of the remarkable things was to look at the U.S. 10-year yield, which is about 126.79 at the moment. Usually during Asia hours is what happens is when we get that buying of the Treasury, when Asia wakes up, they take that as an opportunity to sell. We didn't get that today. Throughout the entirety of the session, from the Asia handoff to Europe, we've seen this buying in the 10-year, a 30-year yield now at 188 as well. So again, really, really a bond market on fire, extreme risk aversion. China 10-year yield pricing in that potential cut to the RRR, that reserve, making 10-year yields now their lowest in China since August of last year. And a German bond, Matt, as you mentioned, at a negative 33 basis points just about. So again, this is risk aversion rippling not just throughout cross assets, but really throughout the globe at the moment, Francine.
Yeah, joining us to talk about this is Ralf Preusser. He's Global Head of Rate Research at Bank of America Global Research. Ralf, thank you so much for joining us. When you look at some of the popular reflation trades being undone, how much more undoing will we see?
Hopefully not much more. On our charts, what our technical analysts have flagged is that 127 to 135 in US 10 years should be the consolidation phase. So from that perspective, we hopefully will have put the low in US 10-year yields today, this week. Having said that, positioning indicators haven't really cleaned up a lot. On our surveys, the short from a month ago was still extremely pronounced. The CFTC data is still flagging sizable speculative shorts. So from that perspective, I worry that we haven't really seen the washout in positioning that you'd normally associate with such a violent snapback in the rates market.
Why do you think we see this move in the first place, Ralf? I mean, just as soon as the Fed makes a hawkish pivot, we're at 170, and now we drop down to 127. As we all know, they're talking taper. You know, aren't we excited for incredible growth this year as earnings season kicks off next week in the U.S. and decent growth next year as well? Why pile into treasuries?
I think there's a combination of factors. I think you're absolutely right. The fact that the Fed signaled the beginning of the policy normalization process, this doesn't make sense for that to be as much of a reversal in the rates market as we have seen, because what we were pricing in for rates to begin with was not particularly ambitious. We were pricing in less than 2 hikes a year, weren't really pricing in much of an effect from the taper into either real yields or swap spreads. So from that perspective, there was a confluence of factors that could easily have led the rates market back towards those levels you mentioned that we saw at the end of the first quarter, call it 1.75, and maybe even a little bit higher. Instead, we've seen the opposite, right? The market is treating the hawkish noises from the Fed as essentially a policy mistake. We are now pricing in 2 hikes for the first year and then less than 1 hike for every year thereafter. With a Fed that is never able to raise rates much above 1.5%, that is painting an extremely dire picture of the underlying recovery, and I don't think really squares with what is by and large still a very dovish message from the Fed. And we can't really justify the moves either by pointing to what has happened in other asset classes, because the correction in the equity market has only started in the last couple of days or so. Until then,
Ralf,
risk assets were quite solid.
I'm wondering about what you're saying that you're seeing the positioning look like. You say that the shorts haven't been totally washed out. Perhaps this mood isn't justified, but if you're an investor in this environment, should you be worried that this type of day is going to continue if we haven't had that washing out in positions?
That's the risk, right? And that's why I find it so difficult to call the end of this, from our perspective, very counterintuitive move. We are still in the higher rates camp. We are still confident that we see a full recovery in the US economy that is going to see the output gaps close by this year, is going to start producing positive output gaps next year that results in much more pricing power than we've seen in the US basically at any time since 2008. That is not an environment where we should be pricing in US 10-year below the previous all-time lows, bar the COVID lows of last year.
But Ralf, if Treasury goes at 1%, if that yield 10-year 1%, what does it tell us?
It tells us that every other asset on the planet is mispriced, right? Because if the rates market is right, then equities are way too rich, commodities are way too rich, the dollar is way too cheap. Because that is an environment in which we have credit is way too tight, because that would be an environment in which we've completely misjudged the global recovery. Even though I'm a rates guy and I'm obviously therefore inclined to think that my market is always the correct one, in this case, I really, really hope it's not, because the picture that it would paint for the global recovery would be an extremely dire one.
Ralf, standing against your peers, your more bearish peers perhaps in the bond market, Ralf Preusser, Global Head of Rates Research at Bank of America Global Research. Thank you so much for joining. And as we're talking, we're continuing to see markets in the red, that risk aversion. So I want to give us a quick check on where we stand at the moment. It definitely is those more cyclical parts of the market that are under pressure this morning. You look at the stock 600 down 1.3%. That doesn't have the benefit of a big tech that's going to help to prevent some of the losses. But Russell 2000 index down nearly 1.4%. S&P futures down 1%. And that on fire bond market that Ralf was just talking about, shorts not washed out yet, he says. We're at a 10-year nominal yield at 127.12. If you are fleeing today, you are fleeing towards that bond market. Again, a pretty ugly day out there, one where you're going to be hard-pressed to find any safety. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Eric Adams, Democratic nominee for New York City mayor. This is Bloomberg.
In terms of marginal change, China's the single most important place for world GDP and most sectors that anything to do with it. And what actually, as I touched on before the break, is interesting in addition to the issues you've raised, the big surprise of late spring, early summer is that the Chinese economy appears to be slowing. And that's not what was really expected. And some of the indicators suggest a significant slowing. So it's a particularly complicated twist for Chinese policymakers, where they've got all these issues where they seemingly are trying to be really tough on some of their own top tech players, as well as the ongoing battles they've got with the US and other parts of the West. So this is another delicate moment for China. And as I touched on earlier, I find myself wondering, because of the importance I attach to China, whether indirectly maybe it's that which is starting to also contribute to the move in bond markets the past week or so.
Jim O'Neill there, chairman of Chatham House, talking about China earlier on Bloomberg. Now, joining us is our Bloomberg M Live editor. He's Eddie van der Walt. Eddie, are we underestimating the fact that actually the markets are now worried about how you exit the pandemic, because you're seeing China and PBOC needing to do more? It's not as, I guess, straight line as we thought it could be.
Oh, absolutely. And you know what? China has been absolutely key in all of this. I think people forget that when all of this started, and it started in China in March or so last year, we were all trying to look at Chinese pollution data, trying to see how quickly China is starting up again. And China was absolutely key in telling us how quickly economies will start to get going again in the wake of the pandemic. And I think we're seeing a little bit of that again now. And Jim O'Neill's obviously one of the smartest guys in markets, and has nailed it on the head. China is a key determinant factor here, and not just in what it tells us, but also in how the rest of the world, how it drives growth in the rest of the world. Now, there's one other factor, though. The cooling of oil prices, I think, has been a significant factor in the last few days. The fact that perhaps that is not as inflationary as people had expected takes some of the wind out of the sails out of the reflation trade.
Jim O'Neill is one of the smartest guys, full stop, right? And he reminds me a lot of Stephen Major. Major has a 1% target on the 10-year. How low do you think we go in yields, Eddie? And do you see people starting to buy other kind of safe haven assets? The yen is stronger against the dollar. Gold is back over 1,800 at 1,811 right now. Does this continue along the traditional playbook?
Yeah, I think, what, I'd hate to make a call on the big bond market. I'm not, maybe if I was as smart as Jim, I'd try that. But I'll tell you what I do think. I think that the key to that conundrum is the oil price, because I think, initially after we had that ructions at OPEC on Monday, when the US was still on holiday, people were talking about, people were saying that, trouble at OPEC, perhaps we could see more pumping for longer. But OPEC is a cartel. A cartel likes to keep prices elevated. If there's trouble at the cartel, oil prices start to sag. And you see what happens then is suddenly all the inflation or reflation narrative starts to fade a little bit. And, and then the bond market looks a little bit more appealing. And we could see that flow into the longer end treasuries continue. So I think the oil price here and the Saudis hold the key to all of this.
Yeah, certainly a lot of volatility in oil. And Eddie, I do also feel like a different contour of this market than in years past is the broad participation of retail, maybe in some of the more speculative things. Do we have any sense to how that type of investor will behave on a day like today? Could that contribute to some of the red we're seeing on the screen? Or are they more likely to buy up their favorite meme stocks when everything else is selling off?
Buy the dip. Buy the dip, buy the dip, buy the dip. That's the mantra, isn't it? I mean, that's the meme stock mantra, is buy the dip, except when you're squeezing the shorts. So I think it's interesting to see which way they're gonna go here. But no, I think that category of investor are very much long. Love to see the big rallies, love to see the reflation trade. So I think that's the side that they will come down on. But whether they'll be distracted by the football and the tennis and all of the other things over summer, I don't know. We will have to wait and see over the next few days.
Distracted by
but
the
certainly
football?
It looks like it's.
Eddie, no one's. I actually asked Jim O'Neill. Yeah, I can't believe you just said that either, Eddie. I asked Jim O'Neill whether there's going to be an economic bounce, and he said, "Look, don't wait for it here in the UK if England win on Sunday." Eddie, what do you make of the ECB with the strategic review? Does it just pale in comparison today because it could have an effect on the markets, but much longer term, given we're nowhere near 2% inflation?
Right. I think there's three really interesting tugs in different directions. Right. On the one hand, we've got the ECB saying, look, we're quite happy to see inflation above 2%, possibly. On the other hand, we're hearing the Fed say, actually, we're starting to get a little bit worried about inflation, and the market saying, well, what inflation are you talking about? And I think of those three, the ECB review has been in the making the longest. The Fed minutes are now more than a week old. And I think the market is the one that's most up to date. Therefore, I'm going to listen to the market here and say, listen, perhaps inflation is, after all, transitory.
To be fair, the ECB move was long telegraphed. Marcus Ashworth called this over a month ago, and I'm guessing he made that call standing on the shoulders of giants. So this isn't unexpected, to say the least. In terms of actual inflation, are we really going to see it, Eddie? Do we know now whether inflation was transitory, or are we still waiting for data to show in the US, in Europe, if we're really going to get a structural shift?
Yeah, I think the supply chain pressures are still there. When you look at the PMI data, when you dig down into the PMI reports, all of it is about, slowing supply to the factory gate and struggling to get, goods manufactured and out the door. So I think that pressure remains. But again, coming back to the oil price, if the oil price comes off, that takes so much pressure off inflation, which, oil price, given an increase in supply, there's no reason the oil price should be, above $70 for WTI and Brent. And I think that will be the key. But at the same time, the other pressures haven't gone away. We are still struggling with those, constrained supply chains, chip shortages, shipping costs rising. All of those factors are still at play.
All right, thanks so much, Eddie van der Veld there from our MLive team. I urge everyone to go and check out a really cool blog on the terminal, but also on our website. So we'll have plenty more on the markets with a move in treasuries, a move in futures. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off today. Now let's get straight to Tom Keene, co-anchor of Bloomberg Surveillance. Tom, I know you were way out front in terms of yield movements and what treasuries are telling us now.
Well, they're telling us more this morning. We have a continuation of what I'm going to call a growth scare. It's back down to ranges. Have we broken out of ranges? Maybe not, but the markets are interesting and we'll be all over that right from the top. There's a busy news day, Francine. As you know, buried in it is the usual 8:30 claims. This is an incredibly elegant chart. It is the most elegant chart I have. I'm not going to go into the math right now, Francine, but this is an inertial force to a lower, better claim statistic. The blue line down below is near 200,000 claims. That's sort of normal, and we are on our way to normal.
Yeah, Tom, I know you're also looking at some of the other things, including the ECB with a possible press conference of Christine Lagarde later.
Yeah, we're going to have a press conference. What do you think? I mean, the one I want to talk to, Francine, is the Germans. You give me any German right now, the finance minister, the head of the bank. You know these people better than me, Francine, but this is not a routine press conference.
No, it's not. And you're right that it is probably putting away the issue of some of the legal challenges that we've seen in the past. So it may not have a huge impact on the market straight away, also because we have not seen inflation near 2% for the last 7 years. But, longer down the road, it's, changes to some of the structural things we're seeing with the ECB. Tom, what are your guests coming on? Who are you speaking to?
We've got a bunch of people. We have the Secretary of Transportation. This could be a 2-hour interview with Mr. Buttigieg. We can't do a 2-hour interview because we have the newly minted mayor of New York City, except it hasn't happened yet. The Democratic primary, with concessions by the two other candidates, and Mr. Adams, we are told, will join us here in the 8 o'clock hour. Caterina Simonetti at Morgan Stanley on the growth scare we are living this morning.
Tom, I'm looking forward to the program. Tom Keener, co-anchor of Bloomberg Surveillance, with everything you need to know on the markets. In the meantime, we're also focusing on what's happening a little bit later, and Danny's all over the ECB strategy review.
Yeah, I think this is going to be really fascinating and kind of, counterintuitively for why we usually like things. I think it's going to be the market reaction, or rather non-reaction. I was talking to Anna Stupanitska from Fidelity earlier today, and she said what the ECB is trying to do is pin inflation expectations higher. You look at what the market's doing right now, that is not a bund that thinks inflation is going to be higher. We're at negative 33 basis points so far. So the market being overshadowed by this risk aversion at the moment, Matt.
I think Tom also makes the point that a lot of global Wall Street is thinking, what are the Germans going to say? But so far, Jens Weidmann has said inflation looks transitory. He's not that worried about it, and he's got to be the hawk that they care about. I'm watching developers. Steve Ballmer joins the $100 billion club. He is now developers. I love this clip so much. He'll never outlive it, but it doesn't matter. He has more than $100 billion. He joined the club of now 9 people who have more than $100 billion yesterday as Microsoft shares went up 0.8%. As Danny Berger points out, if they fall, he'll drop right back below that level, but still, he has a lot of money.
Yeah, this was him excited before he found out he was a centibillionaire. So imagine the excitement today in that office. What I'm watching is UK travel rules. I'm looking at the summer. So we're expected today here in the UK to find out that vaccinated travels, double jabbed, will be freed from UK isolation rules. But at the same time, just minutes ago, we also had a story that France is now warning its citizens against vacationing in Spain and Portugal. So it seems that everything's a little bit up in the air as the rapid spread of Delta variants could wreck Europe's summer. So we'll be following all of those stories, but really full eyes on the markets and treasuries. This is Bloomberg.